In 2000, General Electric was the most valuable company on the planet. Its market capitalization exceeded $600 billion. It employed over 300,000 people across more than 100 countries. It was, by almost every measure, the greatest corporation in American history. By 2023, that market cap had fallen to roughly $100 billion, after the company had been broken into three separate pieces, each a shadow of what the whole once was. Over $400 billion in shareholder value. Gone, not stolen, not lost in a natural disaster, decided away, one boardroom at a time. This is not a story about bad luck. This is a story about what happens when a company mistakes its own mythology for a business strategy. General Electric was founded in 1892, backed in part by Thomas Edison himself. From its earliest days, it wasn't just manufacturing, it was inventing the future. Electric motors, X-ray machines, radio broadcasting, jet engines, nuclear power. If the 20th century ran on electricity, GE built the infrastructure that carried it. By the 1970s, GE was a sprawling industrial conglomerate with fingers in appliances, power generation, aerospace, and media. It was complicated, it was enormous, and it was about to meet the man who would reshape it entirely. Jack Welch became CEO of General Electric in 1981. He was 45 years old, aggressive, and had a philosophy that was, at the time, genuinely radical. If a GE business unit wasn't number one or number two in its industry, it got fixed, sold, or shut down. No exceptions. No sentiment. In his first 2 years, Welch eliminated roughly 100,000 jobs. The press called him Neutron Jack, a reference to the neutron bomb, which destroys people but leaves buildings standing. He wore the nickname without much visible discomfort. But Welch also built. Under his watch, GE's revenues grew from $26.8 billion in 1981 to nearly $130 billion by 2000. The stock price rose approximately 4,000% over his tenure. Fortune magazine named him Manager of the Century in 1999. He was named CEO of the Year, twice. Remember that. The engine driving much of that growth, however, was not jet engines or power turbines or medical imaging equipment. It was GE Capital, the company's financial services arm. By the late 1990s, GE Capital was generating nearly half of GE's total profits. A manufacturer running a bank, quietly, impressively, dangerously. GE Capital borrowed money cheaply because it carried GE's sterling AAA credit rating and invested it in higher-yield assets, mortgages, commercial real estate, corporate loans, leveraged buyouts. The returns were extraordinary. The risk exposure was substantial. The board saw the returns. The risk, apparently, was less interesting. In 2001, Welch handed the company to Jeff Immelt. It was, by any measure, a poisoned inheritance, though neither man seemed to fully recognize that at the time. GE's earnings quality was increasingly dependent on financial engineering. Its industrial businesses were being quietly starved of investment. And the accounting, according to later critics and regulators, was creative. Immelt arrived with ambitions to pivot GE back toward its industrial roots. He invested heavily in wind energy, healthcare technology, and oil and gas equipment. These were reasonable bets on the future. The execution, however, was less reasonable. In 2015, GE acquired Alstom's power business for approximately $10.6 billion. It was the largest industrial acquisition in GE's history. The timing was, to put it charitably, not ideal. The global market for gas turbines was about to collapse as renewable energy accelerated and power demand growth slowed. GE's power division would go on to write down billions of dollars in losses directly tied to that acquisition. Meanwhile, Immelt had made another decision that would define his legacy in the worst possible way. In 2007, just before the global financial system began its implosion, GE Capital held approximately $550 billion in assets. Let that number settle. A company that made aircraft engines was running a financial institution larger than most of the world's banks. When Lehman Brothers fell in September 2008 and credit markets froze overnight, GE Capital suddenly could not roll over its short-term debt. The company that had once seemed invincible was, within days, quietly terrified. GE reportedly required emergency support from Warren Buffett's Berkshire Hathaway, $3 billion in preferred stock at a 10% dividend, and a Federal Reserve emergency lending program just to maintain liquidity. The most admired company in America was calling for a lifeline. The board approved the Buffett deal within hours. Of course they did. GE survived 2008, but surviving and recovering are different things. The company spent the next decade slowly dismantling GE Capital, selling off asset after asset, trying to shrink its way back to safety. By 2016, GE Capital's balance sheet had been cut by more than half. The financial engineering that had powered Welch's golden numbers was being unwound at enormous cost. In 2017, Immelt resigned under pressure. GE's stock had fallen roughly 30% during his final year alone. His successor, John Flannery, lasted just 14 months before he too was replaced. GE then cut its dividend, a dividend it had paid without interruption since 1899, to just 1 cent per share. Income investors who had held GE stock for generations as a safe, reliable income source watched in something between disbelief and fury. The SEC launched an accounting investigation. GE paid $200 million to settle charges that it had misled investors about the performance of its power and insurance businesses. Not an admission of wrongdoing, naturally. It never is. By 2021, GE's new CEO Larry Culp, the first outsider ever to run the company, announced the unthinkable. General Electric would be broken apart into 3 separate publicly traded companies: aviation, healthcare, energy. The conglomerate that had defined American industrial ambition for 130 years would simply cease to exist as a unified entity. The aviation business, widely considered GE's crown jewel, was eventually spun off as GE Aerospace. The healthcare division became GE Healthcare. The energy businesses, burdened with years of losses and write-downs, were the last to separate. 3 companies where one empire had stood. The lesson here is not that GE was run by fools. It wasn't. Many of the individual decisions made across those decades were defensible in isolation. The lesson is that success at scale creates its own gravitational field, one that bends judgment, silences dissent, and makes obviously dangerous concentrations of risk look like competitive advantages right up until the moment they don't. GE Capital wasn't a mistake because no one understood finance. It was a mistake because it worked spectacularly well for so long that questioning it became professionally hazardous. The same culture of performance worship that made Jack Welch a legend made it nearly impossible for anyone beneath him to say, clearly and early, that the numbers had a problem. When a company becomes too identified with its own mythology, it loses the capacity for honest self-assessment. And in business, the moment you stop being honest about your weaknesses is the moment your weaknesses start running the company. Next time, the company that invented the category of fast fashion turned it into a $40 billion empire, and then watched the entire model collapse under the weight of its own speed. Subscribe for more hidden empires.